Los Altos. Thanks very much for making the time today. Appreciate that. And hopefully your time will be well spent. Before we dive into the details of the presentation, I want to confirm that everyone can hear us well. If you don't, there is a chat box, or you can actually jump into the conversation as well if you need to do so. So please feel free to ask questions anytime. We're going to actually discuss the schedule very shortly, so you can basically aware when we will be asking questions. So before we dive into the presentation itself, I want to share with you one of the places that really makes me happy here in Silicon Valley. This is a picture that was taken from Rancho San Antonio, and this is one of my favorite areas locally, where myself, my wife, and my children sometimes, and friends as well, we like hiking in this area. It's a place which is very close to where we live. It's a beautiful place, and it just kind of, every time I go there, reinforces how lucky we are to live in this beautiful area with beautiful nature, so close to home, and an industry which is so dominant and prevalent across the world, and particularly these days. So without further ado, let's go into the presentation itself, and we'll talk. This is our agenda for today, where we'll take a few minutes to general introduction. We're going to talk about making the case for real estate investing. Why should everyone be considering that? We'll talk about real estate as an asset class. We'll talk what are the reasons to consider before you're buying a house. We'll make the case for considering buying an investment property in Silicon Valley. We'll talk about another critical element of your success when you dive into real estate, and that is the team that you're going to be working with. Eventually, with all those almost 1.5 to 2 hours of presentation, depends on how fast we're going to go, and questions and so on, we'll depart with my recommendation. And as far as the structure for Q&A, as I mentioned, you can always type your questions in the chat box, and we will have basically, after each segment, we're going to open it up for about 5 minutes, up to 5 minutes of Q&A, and you can basically write your question, as I mentioned, or you can jump in with your microphone and ask them. At the end, also, at the very end, we're also going to have 5 to 15 minutes of Q&A. Anyone who wants to stick around and ask those questions is very welcome to do so. Other than that, anyone who is interested in getting a link to the recording of that presentation, please send us a private message in the chat box with your email address and name, so we can add you to the people who receive this webinar. Okay, so let's get started. So let's talk about our team first. So our team is made of myself and 4 other individuals. Asaf, who is my son, who works on the residential side of our real estate. Ella also is doing the Silicon Valley residential. We have Nati, who specializes in real estate investment, and particularly outside of Silicon Valley. And we have Amit Urban, who is my older son, who specializes in commercial real estate investment, and he's advisor to our group as well as to our client. My wife and I arrived to Silicon Valley back in 1985. And since our arrival, we have been doing a lot of investments, both locally and across the country. Currently, the areas that we are investing in, as you can see, Silicon Valley, Sacramento, Las Vegas, Phoenix, Nashville, Albuquerque, Atlanta, and Knoxville, North Dallas, and Portland. Portland is actually a new type of investment for us, where we actually invested close to $2 million in a development of commercial real estate. In this particular case, it was a Hyatt hotel in Portland. And the matter of the truth is that the project have moved incredibly well until COVID-19, and it was completed at an amazing pace and within budget and it actually officially opened in February of this year, and just to be stricken by the COVID-19, and obviously everyone is aware of what's happening with the coronavirus impact on the economy, on hospitality, hotels, flying, and so on. But nevertheless, we are still very hopeful that that project is going to yield a nice return for every one of our investors. One of the other things that we're very proud of is the fact that we have our clients really consider our services and basically are happy to share their feedback on LinkedIn, Yelp, and Zillow. 100% of our reviews are genuine. We do not play games with that. And I would encourage anyone who has not worked with us in the past to take a look. And obviously, if you are interested, we'll be happy to provide you direct contact information for to get your reference about our services and so on. And we're calling ourselves holistic realtors. And when we talk about holistic realtor, what do we really mean about it? What we mean is that most of the agent, the realtor that you will encounter during your real estate endeavors are typically very much transaction oriented. They will either help you buy or help you sell. Very few, if any, that you might be working right now are also talking about investing in real estate as much as we do. And what we mean by holistic is that we, first of all, want to be your partner when you are considering buying or selling a Silicon Valley home. We do want to be your partners when you are thinking about developing a nationwide residential investment portfolio. And obviously, the holistic meaning that we put behind these words are that any times that you are curious about real estate, you have any question about real estate, whether it's refinancing, remodeling, moving from one place to the other, and so on, we would like the people who you will be calling first for advice. That is our intention. So going back for a second here, so anytime you see something that you have any question about real estate, we would like you to first think about ourselves and making sure that and we will do every effort to make sure to answer your questions. So also we have want to make sure that you're aware that we have an ongoing market updates. We have the Silicon Valley Market Trend Report, which is a monthly publication. Typically, it's published on the 10th of the month, and that reviews the market development in Santa Clara County and San Mateo County. These are the primary two counties that we cover. We have the introduction to real estate investment, which we obviously are currently listening to or participating in. And our next one is on Sunday, August 16. Additionally, we have on a monthly basis real-time Ask Me Anything related to real estate, which is on July 16, and you're welcome to call and relay any question you may have. If you have some question that needs some research, please send us an email so we can relate to that and find the answers to that prior to the real streaming event. Additionally, we have on July 26th, the Silicon Valley Home Buyers webinar, where we cover the history of the current market, the impact of the virus on our market. We're going to be talking about comparing real estate to other asset class and so on, and make our recommendation about timing the market, whether it's a good time to buy, whether Silicon Valley real estate is in a bubble, and many other topics that we cover. Also, anyone who wants to look at some prior presentation, please go to our website. You will find a link to our YouTube channels and a lot of other previous market trend report. You can find information about different resources and so on. It's a site with rich with information that you will find valuable. Without further ado, we're going to now start the presentation itself, and we're going to start promoting the notion of why everyone should be making or thinking about investing. And as the title says, life is a challenge on many levels. One of them is obviously the financial challenge. And if we can look at our life basically in phases, and I chose to allocate those our life expectancy into 3 phases. One, obviously, the first one, which is roughly until you are 22 age old, and if you are fortunate and lucky, it's a sort of a carefree life. I know it's not true for everyone. There are a lot of challenges in many different areas in the country as well as across the world. But if you're lucky enough to have this carefree life where your parents take care of all your needs during that period, then that's what happened. The second, the second part of life, which is your working career, which in a sense you are on your own and you have to start thinking about your family that you will be starting. And as you see, this is a very challenging period of your life where during that period you have to accumulate not only you have to make payment for your rent, for the food, shelter, kids, education, entertainment, and all that stuff. You also have to accumulate money for your retirement, which is another incredibly challenging undertaking. And if you and if you are if you are basically in high tech, then basically being still working at the age of 65 is not necessarily something which is guaranteed. So that's something which we have to be very much aware of. And to make things a little bit even clearer, and if we look at ourselves over the years, and what we see here, that as we know, the economy has a tendency of having cycles, okay? It goes up and down, as we know that. And in our particularly in this area, and if you work in high tech, that you know that if your we typically knows that if you are basically here if your age is roughly between 45 plus, and we hit a downside in the economy, and you happen to work in high tech, you're reaching an area that I refer to as the death zone. It's an area which I've experienced myself, and I know a lot of my colleagues have experienced, where companies have to lay off people. And when they lay off people, and you're hitting this, and you are roughly in this age, typically the older people will be the first one to go. I know companies not necessarily admitting to that, but that's the reality. And once the recovery starts, it takes a long time for you to join the workforce again and participate. So given that fact, and also the fact that I believe that you should be reducing your risk as with your age, which basically means that you should start thinking aggressively about investing roughly when you are in this kind of age 30 to 40, right? That's kind of age, and when you should start aggressively thinking about investing and thinking about the question of how you will be able to support your family and yourself, and with not only through those working years, but also through your retirement years. So with that, obviously the question is, how do you, how much money you need, okay? And the rule of thumb, as you can say, is you should basically have the 20, you'll need to gross yearly income by 20 to determine approximately the asset base you're going to need. So in other words, if you think that you're going to need at least $100,000 to maintain your lifestyle during your retirement year, it means that before you retire, you're going to need plus $2 million. And obviously, if you live a richer life or one that is more consumes more of your assets, then you obviously need to have more savings to maintain the lifestyle that you are looking for. Nevertheless, though, the assumption are that the asset base will return about 5% annually. Obviously, you have there's an issue of volatility there. Then we have the long-term inflation, which is a consideration, and obviously we have the lower return. So these are the sort of risks that you should be aware that obviously I'm sure you are aware of that are embedded in any plans that you are going to put together. So the next question is also, okay, I know I have to save money. I know I need how much roughly money I need. So the question is there, where would I put the money? Okay, and you have to determine your allocation basically on obviously your age, family, risk factor, tax rate, and so on. And basically, I'm sure many of you have seen similar charts and how to divide their asset in different categories. Obviously, we have cash, we have stock, stock portfolio, we have bonds, and in the other you can put there probably gold or Bitcoin, as my son likes to promote it and believes in that very much. And obviously I have real estate. Myself and my family, most of our emphases are on real estate. Obviously we do have stock and cash. Obviously we have some Bitcoin with the influence of my son, but most of our net value, I would say, is focused on real estate investment. And another point that I want to make, which is very, very important, that investing is a lifelong endeavor. Okay, lifelong endeavor. Anything less is nothing more than speculation. So in other words, what I'm saying here, at least our philosophy, is the philosophy of you need to start thinking about investing early. You need to diversify your investment, and it's the entire thinking is a long-term thinking. It's something that you have to put your time and thought into it, define the objective, and we're going to talk about it more. And it's not something that it's speculative, because anything that is not a long-term is speculative, obviously has risk with that, and so on and so forth. And let's look at now at real estate as an asset class. So what I'm sharing with you right now is basically a long-term view of real estate. And what we see here is what this is the Case-Shiller S&P 500, the Case-Shiller chart, basically, which tries to communicate what are the factors that are impacting the real estate index, okay? And what we see, this index start being tracked since the late 1980s. And what we see that over time it fluctuates. The important period that we're going to be looking at is post Second World War. And what we see that it fluctuates over time, we see some bumps, okay, which we're going to be talking about it in a second. So what are actually the factors that are impacting the real estate index, okay? And what we see here is obviously the first one is the interest rate, which is basically the cost of capital. And as we see that over a very, very long period of time, it's relatively flat. And with the exception here, we see here at 21.5, which was in the Reagan Carter years, where the inflation was very high. And can you imagine, today's rates are roughly about 3.5 is on the high end. Today you can find a 30-year fix for around 3%. Obviously, it depends on your FICO score, debt to income, and many other factors. But in general, it's around 3.5%. During this year, we had a huge inflation, and anyone can imagine and look at their interest rate on the mortgage rate. If they would have to pay 21.5%, it's basically most of people would not be able to make those kind of payments. Obviously, the prices of home during that time is by far not what it is today. The second factor that impacting obviously the real estate index is the population. And as you can see, that the US population from the late 1880s is growing steadily. And that is a very, very important factor. And if we look at currently what's the population in the United States as of basically January of this year, we see we are about 330 million people. We have one birth every 8 seconds, death every 11 seconds. I'm sure these numbers are a little bit different today with the coronavirus. One international migrant every day, 34 seconds, and a net gain in one person every 19 seconds. So that is a very important fact that basically fuels the US economy, unlike many other Western countries, Europe, Russia, and Japan and others, which they have actually a negative population growth, which is very critical, has a very severe long-term implication about the economy, people retiring and so on. But nevertheless, though, this is a very important factor that impacts the continued growth of the US economy. The other factors which is impacting the real estate housing index is the building cost. And when we talk about building costs, we obviously have from land, materials such as lumber, copper, steel, and so on and so forth, labor and so on. So those components also fluctuate with inflation, and they fluctuate based on the geography. We know that Silicon Valley is very expensive compared to maybe areas like Atlanta, Arizona, Tennessee, and so on. And that's the factors. And if we look at the end of last year, we see that the US median price was roughly about $270,000, and its appreciation from the previous year was about almost 3.7%. But the interesting thing here is that you see if we divide it to two main components, one which is land, and the other one is the construction. As we said, the construction is labor, materials, utilities, and so on and so forth. In the United States, on average, the land cost is about 1/3, and the construction cost is 2/3. If we look at Silicon Valley and we look at Palo Alto particularly, we see the reverse, that the cost of construction is about 30% and the cost of land is about 70%. And that's a very interesting distinction, because the land component basically tells everyone that this depends on the local economy, the local industry, and the local demographics. While the cost of construction, even in Silicon Valley, if you compare the Silicon Valley cost of construction to other places' cost of construction, it's probably about almost 50% more expensive. For instance, some of the investment properties that we buy in areas like Tennessee and Arizona and Atlanta, the cost of construction per square foot of, let's call it average Home Depot quality, is about $100 to $150 per square foot. In Silicon Valley, the cost of construction on similar quality home is $250 to $350. So we see the cost of construction locally. It depends also obviously on the cost of rent, cost of employment, and so on. So it varies. Nevertheless, though, it's still about 1/3 of what versus the total cost, because the land cost is the most significant component of cost in Silicon Valley. And if we look at two bumps that we have, we had a bump here and a correction, and another bump and a correction here, and then we obviously had another increase, but the bump actually took much longer to correct, and it's obviously that led to the financial crisis that we have all experienced in the roughly 8 to 2012. So, and if we look and we're trying to see where we are today, and so where we are today, we'll look at different areas. So we look at the San Francisco area as an area that has significantly, basically the prices have significantly appreciated compared to the 2008 bubble to 2012, and we are already past those limits. As you can see, if you look at it more closely, you see some correction, and those kind of correction that we see here basically did happen when back in the end of 2018, the Fed started increasing their interest rate, which resulted in the stock market the drop of about 20%. Okay, that's the drop of the 20% here. And then with the Fed increasing, basically changing course and reducing against the interest rate, which again resulted in a rise in property values. And again, we have some correction here with the coronavirus hitting us. So this is our San Francisco area. If we're looking at Las Vegas has not yet recovered from the bubble that they experienced back in 2002 to 2007. And as you can see, a very dramatic and sharp increase, a dramatic fall here, and yet not even recovered from those peaks of the previous bubble. And if we look at another area that we're investing in is Phoenix, similar story, but a faster, better recovery, where we still have about 30% gap here versus the gap that we see here in this area. So if we look at Atlanta area, we see that actually like Silicon Valley has actually surpassed the highs of the 2007, and they are already above those values today. Okay, good. So if we look at obviously we look at the long-term view on the demand side. So obviously what we see here that anytime we see that the ownership rate, okay, this is red is the ownership rate, and ownership rate meaning people who own homes versus rent. Obviously, the connection is very obviously that the vacancy, which basically on a rental property, which basically goes to affordability, which we're going to touch a little bit later. So anytime more people can buy homes and own them, we see that the vacancy rate goes up because those people who can buy, basically they're vacating the rental properties, and if there is not enough demand or enough growth, then basically the vacancy rate. So one of the things that we have to, when we are looking at investing, is we obviously want to make sure that we're investing in area where the affordability is not very high, because if the affordability is very high, so much less people are going to need rental property. So this is the kind of balances that we're going to be watching in the future as we are looking into our investment properties. So this is obviously what we see the dot-com crash here, where this, what we see here that the ownership rate basically goes down here, okay? We see here that once the ownership, once we see here the dot-com crash, ownership dropped dramatically, okay? We see dramatic drop in the ownership, which obviously result again from an obvious reason that vacancy rate drops as well. So what we can see is that vacancy rate and ownership are basically tracking each other. And so the simple conclusion, as I mentioned earlier, is the more affordable it is, the less it's attractive to invest in those areas. If we look at this kind of the relationship between supply demand, and what we're looking here is that the increase in labor force, okay? So obviously one of the big consideration for investing in real estate is always asking the question, who are the people who are going to be renting the places? What is the status of the job market, the local job market? And what we want to see in general, we want to make sure, we also want to see in general that the labor force increase, okay, is faster than the percentage of housing supply. And you always want to see a gap between labor increase and supply, okay? If it's reverse, then obviously your rental unit is going to be staying vacant. So we want to watch all the time the relationship between the labor force increase, which basically increase the population. When we look at the population growth, obviously there would not be a major population growth unless there is places for people to work. So we always want to watch that kind of ratio between job growth and supply growth. And if we look at Silicon Valley, we see that every place in Silicon Valley, from San Jose compared to San Francisco, that has a bigger gap. And obviously, one comment about this, the gap today, with the coronavirus, we know that there's a lot of people who are basically now realizing that being confounded to a house, a multi-unit with no yard and space for the children to walk around and kind of get release some energy. And we see a lot of influx of people from big cities, whether it's San Francisco, New York, and other, into the suburbs. But in general, what we want to see here, again, this gap between labor force increase and supply of housing. And if we look at Silicon Valley again, Redwood City, large gap, Mountain View, Palo Alto, large gap, Cupertino, and so on. And that basically touches one of the points that we're going to be talking a little bit later, and that is making the case for buying investment property in Silicon Valley, which this gap between labor force increase and supply is one factor, obviously not only factor, but one factor that is boding very well for Silicon Valley real estate investment. As we move forward, we see a very impressive chart that talks about 50 years of median price changing in the United States and California. California is the bars, and the United States is the red line. And what we see that over time, we obviously had significant appreciation over year. There were some time when we see some correction in the market, and each one of those is to do something with the economy. During this time when California went through, quote unquote, the dividend of the end of the Cold War, which basically resulted in a lot of base closure and a lot of defense industry moving away and closing California's industries hub, defense industries hub, particularly in Southern California and somewhere in Northern California. The next correction what we see in this market is during this period. Obviously, this is the financial crisis where we've seen prices dropping as much as almost 40%. And as you can see, the correction was obviously painful to a lot of people, but short-lived in terms of the duration of that. And we see another correction here, but from their point on, we see some significant appreciation in California as well as in the United States. If you take another look at the US, for instance, you see that over a period of 51 years, there was never actually a price correction in the median price of the United States. Basically, that if you guys have watched the movie The Big Short, one of the justification for this craziness during this period was the fact that people looked at the chart and say, hey, price in the United States never correct, which obviously we know is not the case. So if we look at those 51 years of median price appreciation, we see that on average, the US is appreciated about 5.3%, and while the California appreciated about 7.27%, which is a very impressive number, particularly if you look at the built-in leverage most real estate has. So, and that's a very impressive number that we are looking at. And as I said, if you put on top of that the leverage, the kind of return that you can expect seeing are quite significant, particularly when you look at the cumulative effect of that kind of appreciation. And obviously, we always have to look at it in reference to what. So the easiest reference that many of my investors are looking at is obviously the stock market. And the one benchmark which is closely followed by a lot of industries is the S&P 500, which tracks the largest companies traded on the stock market. And if you look at their return is about 8.3%, which is higher obviously than California and the United States. But if you look at what I refer to as the average investor who invests in the stock market is probably does not uses leverage, and because of that, their kind of return that they are experiencing are different. Obviously, it has other benefits, and we don't have a scope of actually getting into those right now, but I'm sure that you will be able to find it. And if you have actually a question, I'll be more than happy to talk about those kind of advantages. Compare and contrast the two asset class, the stock market and real estate. So obviously all that has an impact. And what we see here is that the net worth gap between renters and homeowners is significant. And this particular chart is without counting on the value of the home, okay, which even is more significant, because what it basically said that home ownership not only that has a financial return, but it has also a psychological impact on people, which make them more saver, more investor, and so on. And as we see that the gap between renters and homeowners actually grows over time, and to a very, very significant, if for people over age of 36, the gap between homeowners and non-homeowners, excluding home ownership, is significant. And if we look at another chart, which was put together when we are considering actually housing as an investment vehicle, we look at the gap also between renters and homeowners, okay? And here we have about the ages of 50 to 64, where we have the home equities in red and other indirect benefit of homeownership in blue. And if we go of the age of 65 and above, the gap is even further, and we see both increase in the home equity as well as other asset classes, while the net worth of renters are a miserable, unfortunate, less than $10,000. And I don't know exactly all those kind of circumstances where people are renters versus homeowners, but nevertheless, though, these are the facts as we can see that. So I want to also draw a distinction between a home versus a house. A home is, as you can see, is a place where you and your family live in Silicon Valley. The decision to either buy a home or a house is different, and there are things in common as well. And the decision is primarily influenced by intangible. When we talk about intangible, we talk about emotion, location, school, and so on, and financial consideration, price, down payment, and so on. When we talk about a house, which is basically an investment property, obviously the consideration are different. The decision is primarily influenced by tangible consideration, price, return on investment, price, down payment, and so on. But you also can tie, the fact that you buy an investment property in an area where there are good schools and is a safe environment, you typically will have a better chances of getting less maintenance issue, more retention of tenants, and so on. They're not totally disconnected, but these are the primary reason influenced an influencer for making either a decision to buy a home or a decision to buy a house. So when we are now, I want to talk about the financial benefits, the tangible benefits of home ownership. Okay, obviously, and we're going to be talking about both a home and a house. So A home, obviously, where your family lives is in blue, and a house, which is an investment property, is in green. So as you can see, there are some things which are obviously in common for both, and which are different. OPM is obviously the other people money, which is the leverage that I mentioned before, that the overall majority of people who own real estate, whether a home or a house, are using, which is basically a mortgage, okay? And when we have the long-term as a cumulative appreciation over the year, as we discussed earlier, what we see that you have your future value of your investment is equal to the principal, the purchase price, and plus the rate of appreciation. And obviously, because it's a long-term investment, the N stands for the number of years of ownership. So as long as the rate of appreciation is positive, okay, it's greater than zero, you have appreciation, and once the rate of return is negative, it's depreciation. Depreciation in the sense that the house loses its value. And obviously the compounding effect, which is an exponential, has a tremendous impact on building your net value. It's also a hedge against inflation, and hedge basically means it protects you against inflation. And when we have a home, we have two ways of hedges. One is that's many times most typical loan or mortgage that people are taking is as a fixed loan, either a 10-year fix or 30-year fix. And basically, we know that the long-term inflation in the United States is somewhere between 2 to 3%. So in a sense, the real money that you owe the bank every year drops between 2 to 3%. Okay? So first of all, that's one hedge. The other hedge is that we know that we've seen the median rate of appreciation in the United States, which is about 5.3 in the US, about in California about over 7%. We know that basically the homes appreciate above inflation. Okay, and typically, if you look at the Case-Shiller chart, you will see that the median US price roughly on average appreciate with inflation plus 1 point. And those particular chart that we show, that it actually shows roughly the same kind of numbers, and obviously on the average, but particular areas appreciate inflation plus 2, 3, 4, and 5 points. So that's the two ways that we have in the home ownership, versus in the housing. There are three ways, and the third one, when you have an investment property, as everyone knows, that typically a rent increases with inflation. So we have two hedges with home ownership, and we have three hedges with investment properties. Obviously, pay off principal, and it's for saving that the owner is paying as an owner occupied. And when you are investing in real estate and you're breaking even, then obviously that is paid by the tenant. Additionally, there are many government incentives, and since government and taxes is not of our expertise, we want to make sure that before you're making any real estate related decision, you're going to speak to your tax advisor to make sure that you have a full understanding of the tax implication of investing in real estate. So when we are in the home ownership, as a home versus a house, we can deduct interest rate up to $750,000. By the way, that was changed by Trump from $1 million and another $100,000 home equity line. They dropped it to almost $350,000. And property taxes, which basically is now capped at state and local taxes to $10,000. Again, that was the Trump tax law that was basically particularly penalizing people who live in California and New York, and kind of mostly the areas where housing is relatively expensive and property taxes are much. Previously, if you you're not subject to AMT, you would be able to deduct most of those property taxes. And if we look at the median price of California, let's say roughly Silicon Valley is about $1.5 million, then you know that Prop 13 limits, and it's about 1.25. So on 1.5 million, roughly will pay something like $18,000 of property taxes alone, but the limit, the cap is on 10,000 in state and local income taxes, which means that basically many people lost a lot of their tax benefit locally. Tax-free capital gains. Obviously, what that means, if you live in an area that has a very nice appreciation, as a married couple, you can have $500,000 tax-free capital gains, which is very nice. And if you're single, you have $250,000 capital gains free taxes. There is something called the super tax saver, where if you bought a property, which we see that a lot of Silicon Valley, where people bought a property many years ago, so they have capital gains in excess of almost $1 million, $2 million. So they can basically shelter that kind of taxes by doing kind of a combination between turning their home as their primary residence to a rental property for 2 filing seasons, roughly 2 to 3 years, and then selling that and continuously doing investing and so on. And that will basically shelter your entire capital gains against taxes. That's a more complex process. Anyone who has an interest in this subject, I'll be happy to talk to him about it. Deduct all expenses and depreciate improvement and deferral taxes. Okay, so we saw that when you buy a home, you can deduct interest and property taxes. But when you are investing, you are a property owner and you own real estate as a business, and your business is rental property and rental income, you basically have no limit on the expenses. And in addition to that, you get a bonus of depreciate improvement, which basically this element is a paper loss, which doesn't cost you real money. And you can also defer all capital gains taxes. So when you sell the property, you can do an exchange basically, and the exchange allows you to defer your taxes when you exchange from one property to the other. And actually you can defer taxes to its entirety, as if you make that part of your estate, which obviously a limit of in today's to roughly about $24 million for a family that you can pass your estate to your children and so on. Monthly income for life of ownership after deducting all expenses. So we talked about our plans are to basically have passive income for retirement, because otherwise you're going to have to work for your entire life. And I know that nobody or very few want to be in that position. And if they are in that position, it's more hopefully of a choice rather than no choice. So, but that is actually was our plan since we arrived to the United States back in 1985 to develop those sort of generator of passive income for retirement. And obviously used for equity for a source for kids, college, parent support, retirement, and emergency. For instance, now my sons are reaching an age where they are getting married, and obviously part of our commitment to our children is trying to help them without spoiling them too much. And basically, one of the things we can do is use some of the equity that we build in our investment properties to basically help them in this endeavor of establishing a family, finding a home, and so on and so forth. So when we talked about investments, so there are different asset classes, different type of properties, and so on. So what we basically, there's a commercial one, and as you can see that basically that's sort of grayed out. And the reason it's great because we are directly, the Urban Group is not directly doing any commercial real estate. As I mentioned earlier, my son, Amit Urban, who is doing more of investing in the commercial side. So if anyone has an interest, I will be more than happy to put you in touch with him. So on the commercial side, we see apartment complex and so on and so forth. Retail center, storage, hotel, mixed use, mobile, and so on, residential multi-unit, land, raw land, and so on. And what we see here is that the value is basically driven directly from financial metrics In general, commercial real estate and even all type of investing real estate, whether it's commercial or residential or even single family home up to 4, which we do, is very much driven by matrix, okay? By ratios, by cap rate, the gross rent multiplier, internal rate of return, cash flow, and so on. And there are many other parameters, but the message is very much oriented to our finances. When we buy a single family home up to 4, the decision is obviously has an element, financial element, but mostly it's intangible, as we discussed earlier, family, school, and so on and so forth, versus commercial, which is strictly and very much driven by ratios. And there are other venues to invest in commercial real estate, REITs and DST, Delaware Statutory Trust, and typical ownership pools and so on. So there are different types of investment, as I indicated earlier. These are the type that we do not directly involve in, with the exception of the hotel that we participate in Portland, which was our first commercial investment. But in general, these are outside of our expertise, and we obviously can refer you to people who have this expertise in these asset types. The asset that we are involved in is mostly single-family residence, single-family, detached, attached, okay, and condominium and townhomes, and multifamily up to 4 units. This is our forte. This is what we understand. This is what we are comfortable. This is what we are good at. So this is our presentation is geared toward that asset types within this asset class, which is called real estate. So obviously, this is a quick chart, and I'm not asking anyone to basically, and we would not go over all the details of that, but there is many factors that when we compare residential to commercial, there are many differences, and I just listed some of them. As I mentioned earlier, anyone who will send us in the private message or email their name and email address, will be happy to share the link to this presentation. And the next segment is, before buying a house, get answer to the key question. And again, I want to remind you, a house is an investment property. So what are the key questions that everyone should be asking themselves before buying homes? I basically divided it to a few categories. And the first category is underlying economy, real estate market, neighborhood, and property. So these are the 4 categories that everyone should be investigating before buying a house. Okay, so in the underlying economy, what do we have there? What do we include? Population and job growth. Okay, population growth, we talked about it. We want to see that there is a gap between demand and supply. We also want to see, obviously, the population growth is a derivative of job growth, of industry that are attracting new employees. Obviously, we have the historical and projected based on the economy, a major industry. And we want to look what type of industry. Is it the service industry, is it manufacturing industry, financial industry, and so on, because each one of them has a typical profile of potential buyers, potential renters, and potential demographics, which are going to impact our decision. As far as the real estate market goes, a long term, we want to look at the long and the mid-term trends. Okay, real estate is a big mass. Employment is a big mass. It takes a long time to create job opportunities for industries to be established and so on. So we want to look at those long-term economic trends as well as real estate trends. We want to see the ratio between supply and demand. We want to look at the price and affordability. Remember that if the affordability is too high, basically we would not be able to find renters. If the affordability is too low, what kind of exit strategy we're going to have? We might be able to buy a home, but we would not be able to sell it. So you have to find a very fine balance between in the affordability, not too high, not too low, and so on and so forth. A rental market and vacancy. Obviously, we want to make sure that that is as a factor. Location, okay? What are the location? Are we going to go into location where we see population growth? What sort of demographics in school? Is it school? Are the schools good one or not good one? Who is our target market? We want to find the owners renters ratio. Again, a neighborhood with a large percentage of ownership typically will look much better than a neighborhood with a large percentage of renters. So in addition to that, when you have a large percentage of renters, you're basically going to have also a lot of competition. So this kind of ratio is a very important one. Are we interested in property types, single family, condominium, townhome, multifamily? All those kind of factors that are impacting our decision what to buy and where to buy and when to buy, what to buy, how to buy, and so on and so forth. So if we look at the one of the most interesting one is the population growth. We see and we look at the United States as it's projected to be in 2030. And that was developed back in 2005. So it was like a 25 years projection. And if you look, they basically divided the United States to roughly 10 what's called megapolitans. These are areas where the population grows and basically put many cities together and made it a one big area. Like we have in the Northwest, Northern California, Southern California. We're looking about Arizona, Las Vegas area. And then in the South, we look at Texas, Gulf Mexico, and Florida. And in the Northeast, we see the Great Lakes, Atlantic, and the I-85 corridor, which include Atlanta, Georgia, North Carolina, South Carolina, Tennessee, and Virginia. So the 85% of the population, most of the population in the United States, the overwhelming majority of population in the United States is focused in this area. And you see this area of the United States population footprint is very minor. Actually, we'll see that this area in a second, which is the Intermountain area, which basically has experienced a lot of growth in the last 15 years. And if we look at the map, and this is as we indicated, from 2015, if we look at an updated from 2018, we see that the area with the very large population growth is more in dark, and we see the south, the west, okay, the west, and we see the east and the south here. So as you see, most of population growth is in this belt of the south and the west, okay, that is the belt, okay. While we see in the north, the population growth is very, very small compared to the south and the west. Okay. So if we look at where the percentage, if you look at this chart though, between the south and the west, we have almost 87% of the entire United States population is focused in the south and the west. And if we then ask ourselves the question of how much homes we're going to need, okay, we're going to need basically almost 2 million units per year to accommodate that kind of growth, okay? So we see that the growth is mostly concentrated in the south and the west. We need at least about 2 million units, new units every year to accommodate that growth, okay? Which is basically the demand side of real estate. So, but then if we take a look, and we see new housing units started, okay, we see that the blue, okay, what is the second? The blue, which is total units and single family home. So we see that the total units, both multifamily as well as single family. Single family, we have about almost 938,000 a year, and we have total, which is 1.6. So we have about 400, roughly about 400 multi-unit. So we clearly see with this number of 2 million that we see here, then it's clearly that we have a shortfall. Basically, as you remember earlier, we talk about the gap between supply and demand. And we clearly see that there is a gap between the 2 million here and actually the supply that comes online. So when we talked about our investing strategies, okay, we'll talk about the investment strategy that we have, okay. So what is our investment strategy? So our investment strategies is literally geared, okay, very focused. It's very focused. It's focused on generate passive income for retirement. Our primary objective is passive income for retirement. We want to establish a portfolio that's going to generate us income for retirement, okay? Obviously, the secondary parameter that we're looking for is build wealth and legacy. Wealth that we can basically benefit from it from our retirement time, and legacy that we can give away, whatever charity or your family members, whoever you feel suitable. And minimum hassle and risk, okay? We are passive investors. We do not want to, during this working period of our life, we do not want to turn this investment strategy into one that consumes a lot of our time and creates a lot of hassle. At the same time, we do not want to have it very risky, because we want to build a steady stream of investing cash flow to our retirement. And as we indicated earlier, I believe that we should reduce our risk as we get older, as our runway is getting shorter. We need to reduce the risk and making sure that once we hit the retirement age, we have the nest egg that can provide for us that income, so we don't become burden to our children, okay? And we can live independently with and not be dependent on anyone else, and as well as not on the government, not on our children, but mostly depend on our investment that we have done over the years. So with that, our strategy is basically that we're going to have, I said, kind of two passes. The pass A, which basically A and B, and which is involved in buying properties which are in the what I call growth areas. These are typically areas which are higher appreciation, and V, properties which relatively generate better cash flows for the same price than they would generate in other places, okay? So if we assume that we are buying homes roughly that generate about roughly about $1,400 gross rental income per month, okay? And we have a home here that we buy in the growth area and a home here that we buy in the value area. So if we look at our return, so if we look at this equation, which is total return equal cumulative cash flow plus appreciation plus strategic improvement, and I will explain that in a few minutes. So cash flow, typically what we have seen from our experience, that areas that have high cash flow, then typically the appreciation there will be below the US median, okay? Places like Tennessee, Oklahoma, Kentucky, and so on. Places like which have high appreciation, like California, some Arizona area, some Atlanta area, will typically have a lower cash flow. And the reason I'm using this image of portfolio is that you have to start looking at your real estate holding then as a portfolio, because you have a collection of properties with different profile, and you have to look at your total return of the entire portfolio versus just only one property by itself. Obviously, each property that you buy, you want to buy it in a relatively good area, and you want to make the due diligence and so on, so you don't buy a lemon, but you have to balance one with the other. for instance, properties that might be in the area of growth are more expensive than and generate maybe the same money are more expensive that are in the area of more value. So, for instance, we can buy a home in Arizona today, typical for a 3-bedroom, 2-bathroom home, maybe about 1,500 square feet, roughly going to cost you about $240 to $250, $260,000. It's going to generate for us about $1,200 to $1,400. We can buy the same home we can buy a home for about $200,000 in Tennessee that they're going to generate us an income of about $1,500 to $1,700. So the appreciation there historically is a bit lower, even though that we have seen in recent years a very nice appreciation in those areas as well. And that's part of the reason for that is that there is a shortage in supply and there is quite a intense demand. So what is strategic improvement? Strategic improvement is typically, what I refer to is buying investment properties in area where the cost of the land is very expensive, like California, like Silicon Valley. And if you buy properties where the land component is very high and you have enough land that allows you to improve, to add square footage, to add a second floor, to expand the home, then you already capture 2/3 of the cost, and you are basically can increase the value of the property significantly by investing only in the remodeling, only in the addition of square footage. This is what I refer to as the strategic improvement. Okay, so with that in mind, what we do is over time, you build your net wealth, you build your asset base over time. Whatever time interval between the purchase of one property to the other, you see fit. And then I divide our investment life into 2 phases. Okay, the first phase is the equity focus, where you're really focusing on building your asset base during this period. And this is the equity focus period. It's a period where you still maintain a job and you're not necessarily looking for positive cash flow to build to enhance your lifestyle. You're not looking for $1,000, $2,000, $3,000 additional dollar a month to enhance your lifestyle. You mostly want to focus on building your asset base so you can turn that asset base into your cash flow generator during retirement. The second phase is when you are going into the cash flow focus, where you basically probably somewhere here in the 60 to 70 years old, where you phasing out of work, you want to go into retirement, and now you have built enough asset that they become now your net cash flow positive generator. Okay, and you can transition if you want from single family home, which basically these are being advocated, to a multifamily or to DST, a Delaware Statutory Trust, which is basically an investment in real estate without all the hassle of maintaining mortgage and finding new tenants and so on and so forth. So this is another strategy of actually DST is a very much passive way of managing your asset to retirement, which allows you to travel and so on and be relief of all the issues associated with being a landlord, as I mentioned, maintenance issue, payment issue, and so on. And this is mostly what's called a mailbox checks that we receive on a monthly basis, and so on. Again, if you want more details, we will be able to provide you that. When we are transitioning from a single family home into more multifamily home are typically more geared or more efficient in terms of cash flow. So it depends if you want to do that. It's depends on the circumstances and so on. So we want to share with you a few examples that we basically have gone through with our client and ourselves. So this is a recent example for East Tennessee, which a transaction that basically was almost a year ago. As you can see, this house is still under construction. This house was bought directly from the developer. And what we see here that the total cost was about $235,000. And we basically, it's a 2,600 square feet home. So how is it possible to buy something like that in California and Silicon Valley? The answer is obviously no. For $234,000, this is roughly the price that my wife and I are thinking about adding an ADU in our house, which is roughly between 700 to 1,000 square feet. So no way in the world that we would be able to buy something like that in our area. So very, very different what we can expect here. And the monthly rent, the anticipated rate was about $1,500. It actually was a bit higher than that. In addition to that, we are actually also putting a reserve. We put reserve every year on our property to make sure that if the refrigerator will stop working, the air conditioner and so on, we have the reserve that we basically can take care of those maintenance issues. Also, when we look at that cap rate based on total cost, it's about almost 5%, 4.9%. If we're looking at cash on cash return plus equity buildup, which is basically about 15%. So we roughly estimate you're going to make 15% per year on your investment when you're taking the cash flow consideration as well as the equity buildup. So that's one example of that we directly have done last year. In this particular area, we manage roughly about 30 homes in this area. This is another example, and this is in Canton, Georgia. As you can see, this is actually was bought during the previous financial crisis. This is a townhome that we bought from the builder directly. It's a 3-bedroom, 2.5 baths, 1,600 and 1,700 square feet on a relatively small lot. So this particular home, we have a very limited availability of doing what we call the strategic improvement because it's a very small lot. It bought the builder for $117,000. It rents today for about $1,300 a month. Okay, fair market value as of last month, it was between $220,000 roughly to $240,000 per red fee. So this is an example of one of the examples. Another example we bought also during the financial crisis here in Arizona, basically in 2010, Mesa, Arizona. We bought this. It's a 3-bedroom, 2 baths, 1,500 square feet home on a lot of about 6,000. This home has a better chances of addition, the strategic investment, but the question here is the cost of land it's a small one. It's not as critical as we have here in California. We purchased it, REO, which is real estate owned. We purchased it from the bank for $100,000. We're getting about $1,400 on it for a month. And the fair market value of this property, again, as far as last of 516 on Redfin, is about $230,000 to $260,000. So when we bought this house, okay, there is something called intrinsic value. Intrinsic value is when the fair market value is below the replacement cost. This is a house of 1,500 square feet, okay? Remember, they build homes roughly from between 90 to 100. This is the area between 90 to 110. So let's assume $100 per square foot. $100 per square foot, the cost of construction without excluding the cost of land is about $150,000. So this is the greatest purchases you can do, because once the market stabilizes, obviously no new builder are going to build new homes when they're going to lose money. So this is what I refer to as intrinsic value, where the fair market value is below the cost of construction, And these are the best purchases you can find. It's obviously very difficult to find. There's a lot of competition on it, but this is the kind of investment that maybe there is a chance they're going to happen again by the end of the year. This is another example that we personally, the Urban family, actually bought in back in 2018. This is in East Menlo Park. This is a house that it was a 1,100 square feet, 3-bedroom, 1 bath, and we have turned it to 3-bedroom, 1,200 square feet, 2.5 baths, and we're renting it right now to students. It has almost a 6,000 square feet lot, and this is an exceptional example of strategic improvement where we actually already capture the price of the land, and any expansion which we can easily do in this area. Right now it's about 1,200 square feet. We can easily add another 1,000 square feet where we already have paid for the cost of the land. And this is next to Facebook, so we're a big believer in this area, and we are basically looking forward for that. So we bought it for about $1 million, $1,025,000. We put into it around another $250,000 of work into it to make it very modern and compelling to young adults. A square foot is about $1,200. Our current rate is about almost $5,000. And we also put some money in reserve. Our cap rate is about 4%, and what we expect to see a return of almost 18% a year because of the appreciation. We already have seen homes which are smaller than that in that neighborhood, which are going for about $1.4 million, 1.3 to 1.4, which are actually smaller than this, these homes and not as developed. Another property which we actually closed last week. This is in San Jose. One of our clients who actually this is a third property that locally that he buys with us, and his second locally investment property. This is a property here in San Jose where it's a 3-bedroom, 1 bath, 1,260 feet on a 6,700 square feet lot, and that is a prime. This is the lot size is primary for strategic improvement. One of the improvement is number one, turn that into a 3-bedroom, 2 bath, and there is enough place to do it. Another thing that is a major benefit, it has a very big garage, and anyone who is aware of what's happening today with the state law and so on is aware that you are able today to extend ADU and so on, and a 1,600 square feet garage can be easily turned into an ADU and be rented as well. Purchase price of $960, required $70K of improvement, estimated rate on $200 plus only on the main units. I do believe that if we convert the garage, we easily can probably get somewhere between $1,100 to $1,300 easy on it. So this is examples of properties that we have purchased recently in this area. And this is, as I mentioned before, is the ADU and the STF, the strategic improvement, add master bathroom, convert garage to an ADU. So that is an example of some of investment where we've done, just closed it, as I mentioned last week. Another thing that I want to show you is what I call how we leverage an exchange, okay? And this is, yes.
We have a couple questions here from Laura about the examples.
Okay.
So the question is,
go ahead.
Do you want? Okay. Does the cost include property management? Is the first question. And the second question is, are these examples of your personal investments or are they investments of your clients?
So the first question was, does it include property management, or if we do property management?
Does the cost include property management?
Okay. When we are doing our analysis, it includes everything, okay? And we are very conservative in the way we are doing our estimate. We are overestimating our expenses and underestimating our income. So we include everything. We include vacancies, we include maintenance, we include property management, everything. We allocate maintenance every year. Even though you don't typically have maintenance every year, we typically allocate them. So we are very conservative how we're doing our analysis. And we do include everything in our analysis. And the second question was, some of them were our properties. What was it?
Are these examples of your personal investments, or are they investments of your clients?
So I have only one example that is mine. That is the property in East Menlo Park. The other are clients' investment. We generally have under 300 properties, over 300 properties under management in 8 different locations in the United States. And we are referring to ourselves like a second level property management, which basically means we help our client manage their properties, and we are their focal point if that's what they choose to do. And that's what we refer to the second level property management. We manage, as I said, over 300 properties. Every one of our team members own their own properties. Myself included, my wife and I own about 20 properties locally as well as outside of the area. Locally, we own 2 properties. Outside of the area is the other property we had. Some of them we have some partners. Every one of our team members, Ella, Nati, myself, and others, own investment properties. We believe in that long-term approach to real estate investing, and we believe in this asset class that has worked for many people and believe will work for us as well. Other questions?
There's a question from Pam. Yes. What do you factor in as the interest rate on debt or investment properties? Are you buying in cash?
We have some clients who buy in cash, but I would say the overall majority of our clients do not buy in cash, and we do not advocate actually buying in cash because you use the leverage. As far as the interest rate goes, it varies, depends on how many properties you have, what the price was, what's your FICO score, debt to income. But in general, I would say it varies between 3% to 4.5%. Also, it depends if it's a 30-year loan or it's a 15-year loan or it's an ARM. There's a lot of factors that are impacting that, but we are going to help anyone who will be working with us. We're going to help them do the analysis in a way that is basically reflect all those scenarios in their calculation. Okay? So let's move on with this leverage, and we're going to have typically we're going to have the break for questions in a few more slides, but we have about 5 more slides before our next break. So so here is what we talked about: leverage and exchange. So this is Laura. This is a particular example that we have personally done, my wife and ourselves. So this was a property that we bought in basically in 1987, I think, in 1987, yes, for about $175,000. We sold it in February 2004 for $595. Today's fair market value, you see the last update, I've checked the last price is in March of this year, and the fair market value based on Redfin is about 1.3 million. The rent that such a property can generate today is $3,500. It's currently owned by it's occupied by an owner, so it's not rented. But based on a going rate in the area, we estimate the rent to be about $3,500 a month. When we sold it, and when we did an exchange, we put $25,000 in our pocket, and then we bought basically about 6 properties in Phoenix, in Phoenix. This is all Phoenix area, and this is one in Las Vegas. So today, fair market value of that is about $1.5 million. Okay, which you already see is higher than the property here in Santa Clara. And this is an estimate because what we see next is that we actually sold that back in, when did we sell it? I have to look at actually, we sold it a few years back and with a very nice profit. We sold it almost, you see, for on $100,000 profit. We did an exchange and we bought 3 properties in Tennessee, which for a total of about 716. So we went from 260 to 716, and from a rent of about 1,100 to almost 4,000. So our total portfolio of just of the sale of a single home in Santa Clara went from today's market 1.3 to total asset base of about 1.9, and of a rent, gross rent from almost $10,000 to 3,500, from 35 to almost 10,000. So almost 3 times, 2.5 to 3 times better cash flow and equity build up faster because we could do a leveraging than actually keeping the property here in Silicon Valley. So building equity, doing an exchange, and that's the example that Laura, as you asked, this is our own personal example. Okay, and obviously that's something which we can help you do as well. Matter of fact, we have now a client who also is selling a house in Santa Clara, actually not very far from where we sold our property here. They are going to sell, they're going to bring it to the market. It's a 3-1. Well, it's a very much a similar house to what we sold here. And we're going to bring it to the market roughly between 1.3 to 1.3.5. That's roughly where we're going to sell it. And we are also considering a similar exchange with that. That's what we have done personally. Our target going to market is probably about 2 weeks to 4 weeks before we're going to post it in the market. So that's actually an example that we are now involved in. So before buying your Silicon Valley house, a case for investing in Silicon Valley. So I want to make what are the reasons that anyone should be considering making or purchasing an investment property in Silicon Valley. Okay, so again, I like to categorize it in different groups. There's financial consideration, lifestyle and personal consideration, and family consideration. So in the financial consideration, what do I include there? Too much real estate, positive cash flow without enough depreciation. Basically, it means that you're going to have to pay for every dollar, positive cash flow dollar, you're probably going to have to pay somewhere between 30 and 4% taxes, which is painful when you basically know why would you pay this kind of taxes. And one of the things that we have in real estate, which is very nice, is depreciation. And depreciation basically shelters your income so you don't have to pay capital gains, but income taxes on it. Okay? Multiple properties are generating small monthly rent and require too much management. So for instance, if you are getting tired of age of retirement and you have too many properties with too much hassle of management and there is a kind of small amount, we know that in outside of the area, we're talking about a rent income between $1,400 to maybe $2,000 at most. And here in Silicon Valley, we're talking about at least on a single family home, $3,000 probably to the house that we're getting in East Menlo Park for about $5,000 a month. Okay? You own properties in low appreciating area. So we've seen that California, Silicon Valley has a very high average annual appreciation. We look at areas like Atlanta, Tennessee, Arizona, and so on. They have a lower appreciation compared to Silicon Valley. Want to consider the number of properties under management. Basically, you want to take all those properties and consolidate it into a single property, which typically is also possible. So let's say we have a few homes in Tennessee. I can sell 1 or 3, I can see 3 properties. take that money and buy a more expensive property in Silicon Valley. So I got rid of my hassle of managing multiple properties. I can do management here locally myself more sometimes, and maybe, and we can help also. And one of the consideration, have a large amount of invest and don't want too many properties. It depends on how much money you have to invest. If you want to, let's say you have $500,000 or $1 million that you want to diversify, maybe from the stock market and so on, and you don't want to buy $200 to $250 homes, you want to buy maybe homes, put $500,000 into 2 homes versus buying 5 or 6 homes. No interest in positive cash flow, only high appreciation. So basically, people who are in high tax bracket, any new dollar that they get, they will pay about 30 to 40% plus in taxes. And obviously, you don't want to be in that position. Want to diversify your investment portfolio, stock bonds. You have too much of your money in the stock market. You're looking for diversified to different asset class. Another thing which is very true in Silicon Valley compared to other places, and that is that the quality of renters in Silicon Valley are much, much higher. They typically take a better care of the house. They typically don't have delinquencies issues. They typically stay in the house for a longer time. You see the turnover in other type of properties is much higher than we are experiencing here locally, typically. Obviously, it's not true in all cases. Adding value and cash flow by adding square footage. We talked about the strategic improvement. When we know 2/3 of the cost of purchase a home is the land, and since you already paid for that, it makes a lot of sense to be able to add square footage, add ADU, convert a garage, which is going to generate your income. A lifestyle of personal consideration. Your current house is not a good fit for your next phase in life. Let's say you have 3 kids today, and you have maybe 5 bedrooms, and obviously children will eventually leave the house. You want to stay in this area, and all you want is maybe 3-bedroom, 2-bath home from 3,000 square feet to 1,500 square feet, and you want to basically capture some of the appreciation of the future. This is a way for you to better get into the market when taxes are less, and you can benefit from the appreciation as well. Believe real estate investing, but will invest only within short derivatives. And there are some clients of mine who do not believe or do not want to be involved in a remote ownership or investing, and they prefer to be within a driving distance, and they want to manage their own property by themselves. If that's the person you are, definitely that's a good place to start. You are renting. For instance, there are some people who have typically children, and they want their children to be in very good school, whether in the Menlo Park, Los Altos schools, but they cannot afford the median price in Palo Alto, which is about $2.5 million. So they can basically rent a house there at a much reduced cost, and so that they're not missing the appreciation train that is keep moving faster and faster. They can buy a house for their next phase of life, retirement phase, when the kids are out of the house and school are not a factor anymore. But that's basically where you should basically, again, benefit from the lower property taxes, benefit from the appreciation, which is going to happen over the years that you will live in a rental property because your kids want to be in a better schools. Family consideration, establish footprint for children. So as I mentioned earlier, I have 2 sons, and one of the consideration, you want the kids to be around you. How can you help them establish their footprint nearby? And that is getting them some sort of, whether you buy for them, maybe a condominium, a townhome, or something, but just establishing a footprint for their future life locally. And as well, whether it's children or parents, the same consideration. So in my opinion, there are a lot of very good reason to consider investing in Silicon Valley real estate. I've mentioned a few of those. I'm sure there might be other as well. Anyone who has questions, I'll be happy to discuss. And when we talk about Silicon Valley real estate, then a lot of people probably are thinking about what's the future of Silicon Valley real estate. So as you can see in this slide, it's a slide that goes back to 1985 when my wife and myself arrived to Silicon Valley. And basically what we see here, that the demise of Silicon Valley was predicted many, many times before. And basically, we have some conversation today about the impact of the coronavirus and so on, remote working, is Silicon Valley real estate in a bubble or not, and all those questions. The world is definitely changing. There's no question about it. And there will be some implication, but as long as Silicon Valley can maintain its unique position as a center of the world of innovation and technology, I'm less concerned about the Silicon Valley real estate, which in my mind is a very simple and clear derivative of how well the local high-tech innovation industry is doing. With that, and I would like to get a few questions. If there are any questions, let's make a short break here. I want to keep you on time. So where are we in terms of questions? Do we have any questions on the chat? Anyone wants to jump in with some questions?
We have a follow-up from Laura regarding earlier on. She says, thank you. Could you elaborate what are the...
Yes, I have a slide that we will talk in a few minutes about the services we provide. Sorry, can you repeat the last section?
So, yeah, she has a comment on your personal transaction where you took the proceeds and put it into 3 other properties. She's commenting that it's an amazing transaction management.
Yes, it's not easy. You need to have the expertise and the understanding of all those elements. But this is how you build your net value. This is how you plan for the future. And the good news is that we can help you manage that process. And that is, as I mentioned, we are bringing a house to the market in about 3 to 4 weeks. The owners of that property here locally is considering the benefits and drawbacks, and I'll talk about drawbacks in a minute, of making such an investment. And we are happy to help you if you're interested, and walk you through the process and help you through this. And these are the kind of expertise that we bring to this partnership: knowledge, experience, connection. We've done it before. We're here for help you through the process. Other questions?
The first part of her question was, can you elaborate on the business, on the services you provide? What is your business model? I don't know if you answered that.
What I said that in 2 slides or so, I will talk about it in detail. Okay, so I'm moving forward. So before buying a house, okay, drawbacks of ownership, owning rental properties. So I want to be very transparent that, like everything else in life, there are good things and bad things. And anyone who is considering becoming an owner, I want to make sure that they have a full and clear understanding of what does it mean to be an owner. So these are the drawbacks that we have identified over the course of the last 35 years of being a landlord. So drawbacks, tangible. We obviously have the beginning of the process with the search costs, inspection, appraisal, travel, and so on. Transaction costs, okay? Illiquid asset. It's not like being in a stock market where you can click a mouse and you're getting into a position and you're getting out. It's an illiquid asset. The cost of transaction is high typically. As we say here, it can vary, depends on the asset class, location, and so on. So that's something which we should never forget. Administration overhead. Again, there is some management associated with that, even though that we are what we consider ourselves, we have a property management, and we are also a second level property manager, and there is some quote unquote hustle associated with managing that, unlike again hustle of managing your stock portfolio, bond portfolio, and so on. Expenses, interest, insurance, taxes, maintenance, property management, legal, and so on. So obviously there are expenses there. Vacancy while paying bills, meaning while maybe your property is vacant, you still have to pay a mortgage, interest, taxes, insurance, utilities, and so on. All that things can happen. Eviction, tenant damage. We have a sample of 300 properties, and we know that we have some of those issues are coming out, but relatively still today, it's not bad. I do believe it's going to get a little bit worse as we move to the next part of the year because of all the COVID implication and so on. But nevertheless, though, definitely you see that. Lawsuit. For the first time in 35 years that I'm a landlord, I've been sued in Atlanta, actually a frivolous lawsuit, which probably the tenant, I believe, will lose. But nevertheless, though, even that the tenant will lose, I'm going to have probably $2,000 to $5,000 out-of-pocket expenses. Again, the good news is for 35 years, it's the first time it happens to me. Intangible time, and time is basically, I say that it doesn't take more than 1 hour per month per house. So typically, you have the property management dealing with this issue, as well as we are actually helping you as well in this process. Frustration of having to deal with tenants, contractors, property management, and so on. And that's something which is happening. You know, anytime when you deal with people, you have issues. And to be honest, the people who are doing the property management are not, are not engineers. So the kind of response time is a little bit different than what we expect. They're also a different part of the country, which they have a different way of doing business. So these are the kind of things that we will have to deal with. Excited of ownership and obligation drop value and liability, which is true with any asset. And from that reason, we basically say that being a landlord is not for everyone. And we want to make sure that everyone, before they make that kind of decision to get into that, is basically aware of those downsides. So as for this is the question that Laura asked us, okay, TAG, the urban group house buying services. So we look at our services in two ways. They're outside of Silicon Valley, and we do divide them also in two phases. Before you buy, okay, and all the services that we provide. Remember, you can get a copy of that presentation. All you have to do is to send us your name and email address, and we'll send you a copy. So all those services that we provide before you buy, the services we provide after you buy the property, okay? And Laura asked us about the business model, and I'll answer that in a second. And also when you basically, while you own it and when you want to list it. So basically, the way we work basically on a very much on an exclusive base. And our agreement with our clients, after they fill a questionnaire, our agreement basically states that we are working on an exclusive basis only with you and in the area that we are working. So the exclusivity doesn't apply for the entire United States. It's just in the particular area that we decide to, where you decide to work with us. And our services include basically the 1, 2, and basically once we have a signed lease, with the contract, with the tenant, then we are basically getting our consultation fees. Our consultation fees is typically between 2 to 3%. It depends on the value of the property and so on, but in general, it's about 2 to 3%. And as I said here, it's only payable. It's payable only when you have a signed lease with the tenant after we finish the entire process. In addition, it comes with an automatic 2-year property management support. and I'm talking about here the second level property management support. You still will be responsible for paying property management fees to the local company, but our services that will be for free for 2 years. Typically, if you are like most of our clients who don't stop with buying their first one property, they typically buy multiple properties. We waive that third year and fourth year, second tier property management support for the sake of continuous business, referrals, and so on. And the other part, while you own the property, we basically can help you, depends on the individual himself. There are some individuals who prefer to do all of that by themselves, some others who don't have the time, and we help them with that. And obviously, when you're ready to list the property or sell the property, we basically are there to help you. So that is the Silicon Valley, the outside of Silicon Valley. For Silicon Valley, it's a little bit different, but basically, obviously, the first part is similar, okay? Before you buy, all the consideration, education, and all that kind of will take place. It's very similar, but not exactly. And obviously, once you buy it, you also, this particular case, okay, we do not charge typically services, okay? But it also depends on the work. If the house is a move-in ready house and you don't have to deal with anything, then it's free. We're going to help you with no cost, find tenants, screen tenants, and all that stuff. If it does involve with management, contractor, and time consuming for our perspective, we do charge, and it's a per need basis. So we don't have the typical property management of 5 to 10%. We basically have an arrangement which is based on what activities do you need us to do. So that's approach. And obviously, we are always there for you as advisor. And if you, as I mentioned, if you want to do property management, we can help you. So in this particular model, you don't pay us anything except, obviously, when the transaction closes, we do get paid from the seller of the property. And we're going to provide you assistance for free, as long as it's not an incredible time sinks like managing contractor and so on. All the sign-off lease and screening of lease, this is actually on the house. We do not charge you anything for that. So as we all know, the current state of affairs is a lot of uncertainty, okay? No one knows, okay, the full duration and impact of COVID-19. Nobody knows that, okay? We don't know the impact on the economy, and we don't know the impact on the recovery. And I'm sure many of you heard all those terms of recovery. So we would skip that, but obviously there is a lot of uncertainty, and nobody knows, and nobody can answer that question. What we do know, the uncertain path to recovery. And if you look at those, what we do know about Q2, as you can see, a major contraction in the economy. Historically, I'm not sure if we have seen such a fast decline in such a short time. So very major impact on our Q2 numbers. The big question is what's going to happen in Q3 and Q4. And again, if you look at that, the different estimates from other different outfits, from Bank of America, Budget Office, Goldman Sachs, JP Morgan, all the supposedly smart people that are they are basically, their job is to day in and day out and analyze all the data. You see a big variance in their projection for Q2 as well as Q4. So big, from 30% to 4%, okay? No question that there are big uncertainty about the recovery and so on. What's the new normal? We do not know what's the new normal will look like for working, learning, traveling, entertainment, and hospitality. Okay, our entire life is sort of on hold, okay? Will the government extend the unemployment insurance beyond July? Most of you know that the unemployment insurance will expire at the end of July. Nobody knows if the government will renew it, and if they will renew it, will it be the same? One of the big complaints that we heard from many property management in the area that we invest, that the current way that they have structured the unemployment insurance is basically to keep the incentive of a huge amount of people to go back to work, because the unemployment insurance is higher than what they would make while actually working. Another issue is what will happen with the moratorium on foreclosure and evictions. There is different states have different rules, and right now we know that a lot of places are court homes are closed, and there's no eviction. There's moratorium on it. Nobody knows what's going to happen, whether that will be extended or not. And obviously, there's a huge implication on landlords and so on, whether they can, if you cannot do eviction and you cannot get rent, and you still have to pay your mortgages, and those kind of issues has a snowball effect on many, many different segments of the economy. Will the virus reappear during the coming flu season? A big concern, particularly with the incredible reoccurrence of the COVID-19 infection in Florida, Georgia, Arizona, Texas, California, and so on. Huge unknown. And if the current and the past is indication of how well we manage that, then I'm not very optimistic about the coming flu season. Will the effective vaccine be available? Many other unknowns, okay? And by the way, there's a extended moratorium on foreclosure and forbearance and so on. So there is a lot of unknowns in the current environment. The current state of affairs, what do we know? Okay, we know that the economic recovery depends on effective and sustained containment of the COVID-19. There is no question that the biggest factor that they're going to impact our recovery is whether we're going to be the containment of the COVID-19. Okay, number of people who continue to claim unemployment as of July 4th is almost 33 million people, almost 25% of the percentage of the U.S. workforces. An unbelievable number. Okay. The good news is that we see that the jobless claim is actually dropping, but still a significant one. 1.5 million filed for unemployment. This is updated to as late as the end. It's always a little bit lagging, okay? And if we look at the unemployment rate, which is sort of good news, it dropped from 13.3% to 11%, but still a significant rate of unemployment. Well, we also see that 4.2 million, or almost 4.8% of homes are in forbearance. What is forbearance? Forbearance is and it applies only to federal-backed mortgages, okay? Federal-backed mortgages. It's that the federal government allows you to postpone payment, and those payments are being added to the back end of the loan. It's not clear whether, and this is actually, there is an expiration on the forbearance until September, end of September this year, and it's not clear whether the government will extend it or not, and if they will, how they're going to pay it. And so there is a lot of uncertainties and unknown how those things are going to behave. And obviously what we're seeing here, the percentage of by investor type. So we see a significant number, and obviously for March, from almost less than one, everything, if you look here, less than between 0.09 or 0.01 to 0.87, the highest, to incredible number of over 12%. So very significant impact on people who are not able to pay mortgages right now. And obviously, something which is very obviously is the relationship between unemployment, okay, this is unemployment, and delinquency, obviously very closely tied together. Obviously, when people are unemployed, they cannot meet their loan or rent obligation. That is a very clear relationship. And if we look at rental delinquencies, relatively stable, okay, these are rental delinquencies for multiple homes, for apartment building. And we see the delinquencies, surprisingly enough, is relatively stable. If we look from April, May, from here, right now, as of July, it dropped to about 77% who are actually making rent payment. If we look at what actually 32% of U.S. households missed their July housing payment, and when we look about July housing payment, about 19% made no housing payment. And we talk about housing payment, we talk about rent and mortgages. Okay, rent basically they are rented, mortgages owner occupied. Payment in July, we see that 13% paid only portion of their rent. Okay, so we do see it's the first month's increase. Okay, 30% to 31%, and so on. So these are very big numbers that obviously will have implication on the real estate market. Renters low, and obviously renters, low income, and younger households were the most likely to miss their payment. And by the way, when we are looking at investment in real estate, our target market is the entry-level market. In today's U.S. median house prices, they are roughly between $150,000 to $250,000. That is the kind of target that we have, our sweet spot that we are targeting for many reasons. But anyway, and that is the segment of the market that is currently the most impacted of the coronavirus. We know also that the Fed chairman warned that the prolonged recession, and what is the difference between recession and depression? Depression is a recession is a gradual decline in the economy that occurs over the last 6 months, and we all know that that is not the case. It's a rapid decline. So we are mostly in a depression, but we have not crossed. So the only parameter that is actually missing from actually being in a depression is the unemployment rate, which actually dropped to 11%. But obviously, we saw a significant decline in GDP, and we've seen that is actually dropping dramatically. Okay, and the estimate for Q2 is about 30%. So definitely one parameter that we are in depression, the other one we are not yet, and I hope we will not get there. Fed's forward guidance, rates will remain low for the foreseeable future, a very important factor, which makes it home ownership a little more affordable. And for us as investors, if we can now capture those lower interest rates, obviously our cash flow is going to look very good in the future. And the lending market is very transition and for loans that don't conform to Fannie Mae, MAC guidance. Lenders are modifying guidance and requirements for down payment, FICO, income consideration, and sources. Absolutely, we're seeing that banks from Bank of America to Wells Fargo and Chase and so on are constantly modifying their lending requirements and make it tougher and tougher for people to obtain loans, both for buying the owner-occupied home as well as buying investment properties. So everyone should be aware of that. Builder sentiment, which is an interesting actually point. Builder sentiment jumped 21 points to 58. Anything above 50 is good. The largest monthly increase in the National Association of Builders, which is a little bit, to me, a little bit surprising. Okay, because yes, we do not see yet the true impact of COVID-19 a lot of about the market, because we still have a lot of unemployment insurance, and we have the moratorium on foreclosure, we have forbearance, and so on. So we do not see that, and that basically tells me that the builders have not started seeing, or the current activity in the market is such that they have not started seeing that. Where we have 32 million people I do not believe that by the end of the year we're going to have unemployment less than 8 to 10%. And with such an unemployment, and then there will be a lot of people that are going to basically be in an unfortunate position where they will not be able to pay the rents, they will not be able to pay the mortgages. And obviously, the question is, the landlord, would they be able to pay the mortgage payment, and the owner? So I do believe that toward the end of this year, where some of those changes, if the government will change it, and I don't believe the government is going to take all of that away because there will be a catastrophe, but nevertheless, there will be enough, in my opinion, numbers that will allow, hopefully, to find some interesting deals out there. There isn't a single market, okay? There isn't a single market. There's multiple market segments. Each one of them behaves differently, and we should be aware of that. And there is a lot of other people who believe that we will have a major correction in the market, and the market would not be able to recover as fast as some people would like us to believe. If we look at the stock market, I have to admit myself, and I'm sure there are many others who don't fully understand the very sharp recovery of the stock market. And there is a lot of speculation on it, but obviously there is a difference between the stock market and the real economy. So this is how I see the current state of affairs of our economy and the implication on the real estate investment market in general. So selecting your real estate team. The other part of your success is obviously depends who are the partners that you're going to decide to work with. And what I want to provide you in this slide is our criteria, how we look at what are the qualities that you should insist that your partners in these endeavors will have. So knowledge, skills and experience, services, team, and so on. Again, I will go over it because we are running a little bit late. I want to go a little bit faster on that, and you have those slides in them. You're going to get a link to that presentation, and these are all the criteria that I suggest is very, very important for your success, in a sense, or failure in your real estate investment endeavor. Take your time to understand them. Take your time to check references on the partners you choose. Take your time to learn the market and make sure that you fully understand what you're getting into. And for you to be successful in this endeavor, do your homework, take your time, make sure you select the team that will be on your side and will keep your interest as the guiding principle for every recommendation you're going to be making. Many of our clients are not aware that while the purpose obviously is to find you a home, which is typically the top of the iceberg, there is a lot of the activities and that are taking place below the surface that you might not be aware of, and which will determine your success or failure in this endeavor. So, with all those 40 slides that we went through, I want to share with you my recommendation. Number one, you should start investing in real estate if you define your long-term investment objective and strategy, okay? You are comfortable becoming a landlord. Make sure you go back to those drawbacks of becoming a landlord. You are relatively comfortable with your job security. Very important. Make sure that your job security, you're comfortable in your job security, you're not going to lose your job anytime soon. I know that the job security, nobody knows exactly, but if your company is doing well, if you're performing well, then there's less chances of you losing your job. The reverse is also true. You have the down payment and reserve. You have the down payment and reserve. You don't want to push yourself to the limit, okay? You don't want to make investment which depleting your reserve. God forbid, if you're losing your job, You want to make sure that you can provide for your family and make sure that you don't have to file for bankruptcy or lose your properties. So make sure you have enough reserve before you get into investing in real estate. You have been pre-approved by a reputable lender, and we will be happy to put you in touch with one of them. You have researched your target market. You should monitor your target market for buying opportunities, okay? Look at those markets. What's happening there in vacancies? Are there people who are not able to pay their mortgages? Are there REOs there? Look at opportunities in the target market that you want to go into. You identify a real estate team you can trust to provide you required experience and expertise to support. I cannot but emphasize that point, how important it is. You would not be able to become an expert overnight. So work with someone who have done it many times before, have a proven track record, talk to their referrals, ask them about how they work and so on. You believe in a better tomorrow. Obviously, if you believe in a doom and gloom, then less likely that you will be able to want to make the investment. If you believe that, yes, we're going to eventually and hopefully sooner rather than later be able to put the COVID-19 behind us, and hopefully we will pass the flu season relatively okay, then the sun going to shine tomorrow, and we're going to go back to the growing economy, the growing population, and hopefully our political division also going to subside, and we'll be able to focus on really solving problems. So something which I said before as well is that investing is a lifelong endeavor. Anything less than that is speculation. But when you are going to consider getting into this in real estate investing, making sure you take your time and it's not an instant gratification, is something that you have to invest for the long term. And you don't buy an investment property for 1 or 2 years. You buy investment property for 10 to 20 years. And you do that with great attention to details and by taking the time and not speculating. Obviously, every time you deal with the future, there's no guarantees, but you can eliminate a lot of those unknowns by doing your homework. So basically, something which I'd like to ask yourself, those who participated, we're going to greatly appreciate your feedback. Please go to the following URL to share with us your feedback. As probably you can imagine, preparing a webinar is a lot of work and effort, and we are constantly trying to make that webinar better and better. So your feedback would be greatly appreciated. So what's the next step? That's our last stop, last slide before the final Q&A. Schedule a personal follow-up meeting to discuss your wants, needs, and cans. Okay. Get pre-approval by a reputable lender, and we'll be happy to help you there. Agree to an exclusive representation agreement. We only work based on this kind of agreement. As I mentioned earlier, if you're not 100% happy with our service, you always can fire us. It didn't happen so far, and we hope it won't happen in the future. Hopefully, if we're making something which doesn't work or we're not helping you very well, give us your feedback and we can correct. And start searching for your investment property. We have an investor questionnaire that we're trying to fit what you're looking for to your profile. And as I mentioned earlier, to receive a recorded copy of this webinar, please send us a private chat message with your name and email. If you want to, thank you very much for participation. Stay for the follow-up Q&A. We are going to stay for another 10 minutes or 15 minutes. I have an appointment at 4:30, so I have to meet that. So I have another 15 minutes that I can stay. If you have any question, thank you very much. I appreciate your time, and please let me know what question you have.